Yeah, I'd say exaggeration is a good word. I mean, both sides, the US and the Chinese, are front-loading here to get in front of the tariffs. I mean, essentially, you're being able to lock in on a price that might be 10 or 25% cheaper than what it will be in 3 months' time. So it makes a lot of sense for companies to buy the non-perishables and some of these inventories that they can stockpile. So for now, in terms of data, I don't think the export-import numbers are telling us anything. We're probably better looking at the local PMI data to get an understanding of how the sentiment is in China.
And in terms of that sentiment, Geoff, when you talk about what we've seen over the last 24 to 48 hours in the United States in terms of these midterm elections, obviously we're talking about the potential for U.S. President Donald Trump to really refocus on his foreign policy and with that his trade policy, given the fact that he may not be able to move on more issues back at home. How should the markets be reading that?
Well, I think what we're seeing at the moment is the Chinese market is somewhat skeptical, so that's probably the market that's least sort of participating in this rally and follow through from the US overnight. And rightly so, really, because we had that tweet from Donald Trump last week saying that he'd had a conversation with Xi, and you know, the skeptics say that he really did that just to try and get his local stock market, the S&P and the Russell, just a touch higher before people hit the vote stations. So really it's going to be all eyes on the G20 in terms of seeing if we can actually get any traction here, or he's going to leave them hanging.
Yes, Geoff, and certainly it wasn't just about the stock moves before the vote. I mean, we've seen a pretty strong reaction in the equity markets now that the midterms have cleared. But I'm curious about your thoughts in the Forex space, because when it comes to the dollar, there seems to be a belief out there that gridlock could be perhaps put pressure on the dollar to the downside because there won't be additional stimulus. There won't be so much divergence, economically speaking, perhaps with the rest of the world. What is your view?
Well, I think if we look at Trump's main policies, he's actually managed to get a large chunk of those through. It's difficult to come up with a scenario here where the Democrats are actually able to unwind the fiscal push and the tax cuts, so they're likely to stay in place. And one of Trump's sort of remaining things really is an infrastructure spend. And this is an area, again, that the Democrats and the leader of the House, the likely speaker, has actually said should be willing to work with Trump on anyway. So he's still got some levers in terms of the fiscal space. But I'd say yesterday's result doesn't really change the US growth outlook too much. And at the moment, you've still got the Fed, and they're on course, you know, in our view, probably hiking every quarter until things start to roll over. So my metric there would be, unless we see payrolls below 100K in the US or PMIs below 52 in the US, the Fed is still on this hike path. So I think you've got interest rate support for the dollar, and the carry you can make in some of these crosses now is actually pretty material.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now, to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.